Welcome to this lecture on one of the most critical phases of the accounting cycle. Today, we begin our exploration of Chapter 6, Introducing Journal to Ledger. In the world of business, every second brings a new transaction, be it a sale, a purchase, or a payment. But how does a business keep track of all these thousands of events without losing focus or making an error? The answer lies in the systematic process of recording and classifying. We often hear that accounting is the language of business. If that is true, then the journal is the very first sentence we write in our financial story. Throughout the session, we will examine how raw data is transformed into meaningful information, starting with the book of original entry, that means journal. By understanding these mechanics, you will gain the ability to look at a business event and immediately translate it into its professional accounting equivalents. Before we dive into the technical details, let us outline our roadmap for this lecture. By the end of this session, you will be able to achieve 5 core objectives. First, you will define the journal as the book of original entry, understanding its status as the primary records. Second, you will be able to explain the systematic process of journalizing transactions, ensuring you can navigate the path from the receipt to a formal entry. Third, you will explore the profound importance of journals in maintaining books of accounts, organizational transparency, and accuracy. Fourth, you will recognize the vital structured connections between the journal and ledgers, a bridge that transforms a list of dates into a categorized history. Finally, you will apply this concept to practical, real world format and examples. This comprehensive approach ensures you that do not just memorize the rules, but rather understand the logic that governs modern financial record keeping. Let us begin with the concept of journal. In the accounting, we define the journal as the book of original entry. But what does the title actually implies? It means that whenever a business transaction occurs, the journal is the very first place it is formally recorded. The transaction is formally recorded. Think of it as a financial diary that captures the heartbeat of business in real time. Every entry follows a chronological order, meaning transactions are listed day by day as they happen. This ensures that no event is forgotten and that the sequence of business activities remains intact. At the heart of the process is the double entry system. This system is based on fundamental principle that every transaction has a dual effect. Have you ever wondered why balance is so important in accounting? It is because every event affects at least two accounts. One must be debited and another must be credited. By capturing this dual effect, the journal provides a complete picture of the transaction. Furthermore, each entry is followed by a brief narration, which is a simple explanation of what took place. This ensures that anyone reading the books later, whether an auditor or a manager, can understand the context of the numbers. Now that we understand the why, let us look at how. The format of journal is standardized across the globe to ensure consistency. It typically consists of 5 columns: date, particular, ledger, folio, debit amount, and credit amount, as is seen. I'm going to just give you yes. Date, particulars, ledger folio, debit amount, and credit amount. Particular column. This is the most descriptive part of the journal. We write the name of the account in the debit part, and in the second part we write the account name for the credited, which slightly indented. Indented means slightly gapped and preceded by the word to. So the basically entry is account name that is debited to the account name that is credited, and credited does not need a mention of the CR. So below this line, we write the narration in bracket. Okay. Ledger folio. This column is a reference point. It indicates the page number of the ledgers where the specific entry has been transformed. While it remains blank during the initial recording phase, it is essential for the audit trails. debit and credit column. These columns house the monetary values. In this, we write generally the monetary values. The total of the debit column must always equal to the total of the credit column. By utilizing this specific structure, we ensure that every piece of financial data is categorized, quantified, and ready for further analysis. Moving forward, the process of entering transactions into the journal is known as journalizing. It is not merely a task of copying numbers, it is a systematic analytical process. The first step is to analyze the transaction to identify which accounts are affected. For instance, if you pay rent in cash, you must identify the rent account and the cash account. Next, you must decide which account or identify which account to be debited and which account to be credited based on established rule of accounting. Once decision is made, you record the debit and credit, usually followed by the abbreviation DR at the end of the line. The credit entry follows on the next line intended to the right, starting with the word to, after recording the amounts in their respective columns. You must provide a narration, a concise summary starting with the word B. To maintain clarity, a horizontal line is drawn after each complete entry. Finally, at the end of each pages, we total both columns to ensure they are equal. The discipline approach is what separates professional accounting from simple bookkeeping. Brief recap. Journalizing involves analyzing accounts, applying debit and credit rules, recording the entry with a narration, and verifying mathematical accuracy through the pages. The golden rule of journalizing. To journalize correctly, we must master three golden rules of accounting. These rules are categorized based on the type of accounts involved: personal, real, and nominal. First, let us look personal accounts as we discussed in First, let us look at personal accounts as we discussed in earlier classes. These relate to individual, firm, or companies. The rule is here simple: debit the receiver, credit the giver. If you pay a supplier, they are the receiver. If they give you goods on credit, they are the giver. Second, we have real accounts, which relates the asset and second, we have real accounts, which relates to the asset. Second, we have real accounts, which relate to assets and properties. The rule is simple: debit what comes in, credit what goes out. For example, when you buy machinery for cash, machinery comes in, that means it is debited, and cash goes out, that means cash account should be credited. Third, we address nominal accounts, where we deals with the expenses, losses, gains, and incomes. The rule states the rule states debit all expenses and losses and credit all income and gains. If you pay salaries, it is an expense, debit. If you receive interest, it is an income, should be credited. How do this rule ensure consistency? By providing a universal framework, they ensure that two different accountants would record the same transaction in the exact same date. Let us put this rule into practice. Let's put this rule into practice with two common business scenarios. Imagine your business paid a salary of rupees 2,000. First, identify the account, salary and cash. Cash is real accounts and salary is nominal account. So, for nominal account, expense is debited and cash, क्योंकि ये real account है, it should be credited because it is going out from the business. So, credited. The entry would be salary account debit to cash account with the amount of rupees 2,000 with narration being salary paid. Now consider you have received rupees 5,000 for rent. Here is the account are cash and rent. Cash is a real account that is coming in, so we will debit it. Rent is a nominal account and income, so we credit it. The entry will be cash account debit to rent with the narration being rent received in the debit column 5,000, in the credit column is equal to 5,000. Notice the pattern. We always identify the nature of accounts before applying the rules. This logic sequence prevents error and ensures that our financial records accurately reflects the true and fair view of the business and its obligations. In the busy enterprise, multiple transactions of the same nature often occur on the same day. Does it make sense to write 10 separate entries for 10 different expenses paid by cash at once? To increase efficiency, we use compound entries. Compound journal entries is a single entry that records multiple debit and credits related to a single transaction or a set of transactions occurring on the same day. For example, if a business owner pays 15,000 rupees cash as a rent, withdraws rupees 8,000 for personal use on the same day, both involve a cash outflow. Then combine them. We debit the rent account for rupees 15,000 and drawing account for rupees 8,000 while making a single credit to the cash account for total rupees 23,000. This not only saves time and space, but also provides a consolidated view of the day's related activity. Brief recap, the golden rule provides a logic-based framework for debit and credits, while compounding entries allows us to group related to the transactions for better efficiency. Let's walk through the comprehensive example involving a business owner named Shyam. In June 2003, Shyam started his business with a capital of rupees 1 lakh in cash. In our journal, we would debit cash what comes in and credit capital, the giver or owner stake or liability. Next, he deposited rupees 25,000. Next, he deposited rupees 25,000 into the bank. The result in the bank account being debited and cash being credited. He then bought raw material of rupees 5,000 in cash. This is an expense. Therefore, we debit purchase and credit cash. Following this, he sold rupees 50,000 goods to Ram on credit. Here, Ram is the receiver debit and Seth is the income credit. Finally, he paid rupees 50 and a salary of rupees 100 using compound entry. We debit rent and salaries and credit cash account for the total of rupees 1 lakh. For the total of rupees 1 lakh. By looking at these entries collectively, we see the complete financial narrative. By looking at this entry collectively, we see the complete financial narrative of Syam's first month. Can you see how each entry tells a specific part of the story while maintaining the overall balance? Number we discussed, the link between them is the laser folio. Number we discussed earlier. Once a transaction is journalized, it must be posted to the laser. For instance, all cash-related entries from the journal are collected in one place, that is in cash account in the laser. This connection is vital because while the journal tells us when things happen, the journal or laser tells us the final balance of each account. Without this connection, a business would know its daily history but would never know its total cash on hand or its total debt. In summary, we have navigated the foundational journey of transactions. We defined the journal as essential books of original entry that captures every business event in a chronological and dual entry format. We explored the deep importance of maintaining these records for legal practice and error prevention. We mastered the golden rule of accounting, personal, real, and nominal, which provide the logic for every debit and credits. Finally, we recognize that the journal is not an end itself, but the vital basis for the ledger. Understanding these transactions crucial for any graduate students or learners for accounting, as it forms the backbone of all financial reporting. As you reflect on this lecture, remember accuracy in the journal ensures integrity in the final financial statement. You are now prepared to move from recording entries to classifying them in journals. This concludes our lecture here. Thank you.